If you're unprofitable, it's because you are not yet exploiting the market. You think trading patterns will give you an edge, and the logic seems reasonable. But there's just one problem. If patterns were the edge, everyone using them would be profitable, but they are far from it. In this video, I'm going to give you a simple 4-part process to help you exploit the market by finding something to exploit, identifying problems, gathering evidence, and creating rules. First, let's make sure everyone knows how exploiting the market works. Simply put, you can only exploit the market by finding an advantage that allows you to profit over a large sample of trades. This is called an edge, and the process I'm going to teach you will help you find one. Now, look, the process is simple, but it's not easy. There are many ways to develop an edge. Some traders use insider information, some use arbitrage, some use statistical models, but I'm going to teach you a different way. I'm going to teach you how to develop an edge by exploiting repeatable tendencies in price action. A tendency is simply a behavior that price repeatedly exhibits. It's not a guaranteed outcome, it's a recurring characteristic of how price behaves. For example, here price is consolidating. It tends to rotate within a range, so the tendency is rotational behavior. An edge comes from exploiting that tendency by positioning yourself at the extremes of that price action. Here, price is directional. It tends to reach new areas, so the tendency is continuation. An edge comes from positioning yourself with that continuation. And understanding this first step is how you automatically beat 90% of traders because they are stuck mistaking patterns for tendencies. For example, price is moving directionally, a fair value gap forms. Price respects the fair value gap and continues. Most traders think that the fair value gap caused the continuation, but price was already exhibiting a tendency to continue. The pattern simply formed within it. The same thing happens in consolidation. Price respects support. Traders think that the support caused the move higher, but price was already consolidating. It was already exhibiting a tendency to rotate. And this is exactly the first step of exploiting the market. You're going from how do I trade the pattern to how do I position myself in a way that exploits this price action. But without this next step, it means nothing. So now you know what you're trying to exploit, a tendency. But this creates a new problem. How do you actually find a tendency worth exploiting? The answer is surprisingly simple. It's actually right in front of you. But before I show you how to find an edge, you have to understand that this entire process depends on one rule. The rule is to expect price to continue doing what it's currently doing, not because it will, but because it gives you a logical and consistent way to operate within an uncertain environment. Let's also straighten something out before we continue. When I say develop an edge by exploiting tendencies, all I really mean is to position yourself with what price is already doing. Your job is not to predict. Your job is to identify what price is doing and then position yourself with the characteristics of that price action. This is something I explained deeply in my video on how to beat 90% of traders. So if you haven't watched it already, you definitely should before you continue. Now, there are endless ways to describe price action, but most of them fall somewhere between two extremes: direction and consolidation. For example, here price is moving aggressively in one direction. The tendency is continuation. Here price is rotating within a range. The tendency is rotation. And sometimes price does both. It's directional, but it's also consolidating. I call this directional consolidation. Directional consolidation is simply a description of price action that exists between the two extremes. Everything else is just a variation of one of these behaviors. For example, this steeper directional consolidation can still be classified as directional consolidation. It just simply sits closer to direction than it does to consolidation on the price action spectrum. But this is why I want you to start with these three broad categories: direction, consolidation, and directional consolidation. Not because they are the only ways to read price action, but because they help you understand which category you naturally trade best. And this point right here is where most traders make the biggest mistake you could. They make a decision right now. They choose based on preference, on what sounds good, on what they think will make sense. But if you're unprofitable, why would you trust your own opinion? You need evidence, and the only way to get evidence is through testing. Take 100 trades of each: direction, consolidation, directional consolidation. The goal is not to discover which one makes the most money. The goal is to discover which one you feel comfortable trading. You need to remember that exploiting the market requires consistent execution. So if you're not honest with yourself here, everything else will be built on a lie. I chose consolidation, but at the start, I wanted to trade direction because I felt like there was more opportunity. But after testing these different approaches, I realized I do not feel comfortable targeting areas price hasn't reached yet. You may prefer direction because for you, consolidation might feel random. And that's exactly the point. There is no best price action. There's only the price action you understand best. When taking the 300 trades, do not worry about creating rules and refining your entries or anything like that. Your only job is to position yourself logically around the behavior you're trading. If price is consolidating, trade the consolidation logically. If price is directional, trade the direction logically. If price is consolidating directionally, trade that price action logically. Let me say this again. The purpose of these 300 trades is not to build a strategy. The purpose is to understand which type of price action you naturally understand the best. Rules will come later, but you must remember the one rule: do not trade expecting something else to happen. Do not trade consolidation like it will break out. Do not trade direction like it will reverse. Trade what price is doing, not what you think price will do. So start trading on a demo account and collect data for each trade in Excel. Track three things: trade number, price action type, and did it make sense? This is the most important one. After each trade, look back and ask yourself, did my positioning actually make sense? For example, you might notice that every time you trade consolidation, you get stopped out in areas that price consistently trades through, and what you just noticed could be a potential breakthrough. You must write down each thing you notice and question, because we will come to this later, and this is the most important step of developing an edge. Notice what I did not tell you to track: win rate, profit, expectancy. Because if you focus on profits too early, you will end up optimizing the wrong thing. This stage is about building a foundation which lets you exploit the market. Optimization comes later. The did it make sense metric is there to give you a rough idea of your current ability to understand a certain type of price action, but it should never make the final decision for you. The final decision comes from your own experience. Because after 300 intentional trades, you will know. You will be able to say, I don't like consolidation, or I understand direction much better. And only once you have chosen your behavior can you move on to the next part, where I will show you how to go from I trade consolidation into a fully tested strategy capable of exploiting the market. Now that you have chosen your price action, you're ready to start developing an edge. And let me be clear, it does not matter if you chose consolidation, direction, directional consolidation, because they all have the same problem, which is turning an idea like I trade consolidation into a strategy capable of exploiting the market. You see, it's actually simpler than you think, but you need to understand that this is where most traders will fail. They will create rules immediately. They will copy things I mentioned in this video. They will guess, they will assume, and they will end up skipping the most important step, which is understanding what problems they actually need to solve. You see, every improvement in your strategy begins with an observation. That's why I told you to write down everything you notice, because those observations will become the foundation of your strategy. The process looks like this: you make an observation, you ask a question, and you develop an answer. For example, while trading, you may notice I keep trading what I think is consolidation, but it ends up just being a reversal. You may notice my entries feel random because every consolidation looks different. You may notice there are different types of consolidation. You may notice I keep getting stopped out before price action continues without me. You may notice it looks like I'm leaving a lot of profit on the table. Most traders ignore these observations, but these observations are the key to developing an edge. Because each observation contains a question, which, if you are able to answer correctly, it'll take you one step closer to profitability. Let's look at the examples. Observation: I keep trading what I think is consolidation, but it ends up just being a reversal. Question: how can I stop trading reversals that look like consolidation? Observation: my entry feels random because every consolidation looks different. Question: how can I ensure consistent entries across all of my trades? Observation: there are different types of consolidation. Question: doesn't matter if the consolidation looks like this or this. Observation: I keep getting stopped out before price continues without me. Question: is there a stop position that consistently works better than another? Observation: it looks like I'm leaving a lot of profit on the table. Question: is my target leaving profit on the table? Notice something: we still haven't answered a single question. And that's important because most traders immediately try to answer questions with opinions. They guess, they assume, they copy another trader. But if you're trying to exploit the market, an opinion is useless because the market does not care about what you or anyone else believes. At this stage, your job is not to answer the question. Your job is simply to identify the questions hidden inside of the observations you have been recording. You need to think of every observation as a potential weakness in your current process, and every answer will bring you one step closer to an edge. See, to be honest, I'd be pretty impressed if you have already noticed that these questions mainly revolve around two problems: execution problems and performance problems. Execution problems are what is stopping you from trading consistently. Performance problems are what is stopping you from your edge reaching its fullest potential. Question: how can I stop trading reversals that look like consolidation? Question: how can I make my entries more consistent? These are questions that revolve around execution problems. The purpose of these questions is not to increase profitability directly. The purpose is to reduce execution inconsistency. For example, trading reversals that look like consolidation stems from one major problem: premature entries. So, a logical approach to this is to delay your entries. You may decide to only trade consolidations that are at least 8 candles in length. This would allow the potential price action you're trying to trade to prove it is what you think it will be. Making your entries consistent depends on having a mechanical entry rule, like entering 20% above the consolidation low. These rules are not trying to create an edge, they are not high probability, they do not increase win rate. They are simply helping you execute consistently. If the rule solves the problem, it stays. If the rule doesn't, you change it. For example, does waiting for consolidation to be 8 candles in length stop you from trading price action, which is not consolidation? If the answer is yes, then the rule stays. Does entering 20% from the consolidation low help you enter consistently across all trades? If the answer is yes, then the rule stays. Now look, questions about performance are different. These questions directly affect your edge. For example, does consolidation type matter? Is my stop loss in the optimal place? Am I leaving profit on the table? These questions require you to collect data so that you can answer them accurately. So every piece of data you collect should connect back to the question you're trying to answer. For example, question: does consolidation type matter? The data you collect is consolidation type, trade result, expectancy. Question: is my stop loss in the optimal place? Data: stop placement, trade result, expectancy. Question: am I leaving profit on the table? Data: MFE, trade result, expectancy of each risk to reward. Notice something: the data you collect changes depending on the question. There is no perfect spreadsheet, there is no perfect journal. The purpose of data is to answer questions, because, like I said, every unanswered question is a potential weakness in your edge. So, once you have enough evidence to answer a question, you can finally stop guessing and you can finally make a decision. And that decision becomes a rule, which brings us to the final step of creating an edge. So now we have answers, but answers alone do not help you become profitable, because knowing and acting are not the same thing. Which brings us to refinement, the process of turning data into rules capable of exploiting the market. For example, the question: does consolidation type matter? Well, the answer you generate from the data you collected is no, because you found that there isn't a major difference between consolidation types. Rule: well, you don't create a rule because there is no difference. Question: is my stop loss in the optimal place? Answer: yes. 25% outside of the consolidation performs the best. Rule: place the stop 25% outside of the consolidation. Question: am I leaving profit on the table? Answer: no, I was actually aiming for too much profit. Rule: adjust risk to reward to zero point 0.7. Notice something: the rule wasn't created because it sounded logical. The rule wasn't created because another trader uses it. The rule was created because evidence supported it. This is how every performance rule in your strategy should be developed. Not through opinions, not through assumptions, through evidence. And once you repeat this process enough times, observation, question, answer, rule, you no longer have an idea. You have a strategy. And if that strategy can consistently exploit a tendency in price action, then you have an edge. So let's recap the entire process. Most traders try to exploit the market by finding patterns. But patterns are not what creates an edge. Tendencies create an edge. So the first step is finding a tendency you want to exploit. You do that by exploring different types of price action and finding the behavior that you naturally trade best. Once you have chosen your behavior, you start observing problems. Every problem becomes a question. Every answer needs a question. Some answers come from logical execution rules, others require data. Once you have enough evidence, you turn those answers into rules. And once you repeat this process enough times, observation, question, answer, rule, you no longer have random ideas. You no longer have opinions. You no longer have guesses. You have a process specifically and uniquely designed to consistently exploit a tendency in price action. You have an edge. And if you are able to execute that edge consistently, you can exploit the market again and again and again.